So excited to have you, Mary. Thanks for joining us. Within her role at CattleFax, Mary watches trends within the industry, serves as a speaker at conferences, provides insights and updates, and works with farmers and ranchers to help understand their risk in the industry. As a reminder, this webinar is intended for informational purposes only and is not public or for media consumption. Any opinions expressed by presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you for joining us. This event will be recorded and distributed following the webinar. So Mary, I will pass it on to you. Everything presented well?
Yeah, I think
All
so.
right.
Thanks, Claire.
Go right ahead.
Yeah, thanks for joining us today. And like Claire said, any questions, put in the chat, and this will be shared. This presentation will be shared with you after both the recording and then also the slides. So you'll be able to look back at any of this later. But yeah, great to be with you all. As you know, it's been a pretty exciting market here lately, pushing into all-time highs all throughout the sector, all throughout the industry. And great demand is going on. So we're going to get into it and then look at our expectations going forward. So to start out, I'm sure a lot of you are familiar with the term the cattle cycle. As probably a lot of you know, cattle tend to have a 10 to 12-year cycle where we see kind of like this movement where cattle prices go up at the time where our numbers are down. It takes several years to rebuild the herd because, of course, the reproduction cycle for cattle is much slower than most other industries. So right now, we would say that we're at the low of the cattle cycle, and so we're headed into rebuilding here, but it's going to be a slower rebuild. Our inventories aren't probably going to get to what they got to last time we rebuilt. But typically at this time is when we do see the highs in these cattle prices. But typically the cycle works where it's 5 years or so moving upwards with cattle prices as the inventories go lower. And then we do get into the rebuild. And as we grow, we tend to see 5 to 6 years on the downside. So we would say that we're near the end of the upside on the cattle cycle. But as we look at that, we expect to see a slower rebuild and then a slower decline to these prices. But we'll get into that here in just a few minutes. This is what we like to call the sustainability slide. As we've moved forward, we've continued to be more efficient with bigger weights, better animal husbandry, and then just more utilization on the dairy side for the beef industry. So what we've seen over time is that even though the cattle inventory has been generally declining since the 70s, we've continued to see beef production stay pretty elevated. We are moving lower, of course, as we do get into smaller numbers, but the decline's a lot less than what we see on the cattle inventory as we do continue to see more efficiency within the cattle industry. So this is just a great story for our industry and what we've done to be efficient and to stay strong even as we do see those challenges with land values, aging producers, and other things that are going to continue to limit the size of our cattle herd. So as we think about expansion, our formula here is grass plus cash equals calves. So we're in a time where we are seeing a lot of cash. Grass is pretty mixed depending on what part of the country you're in, but if you think of just like the last 5 years, at least 3 out of 5 would be considered pretty dry, and maybe 4 out of 5 for most areas. So even if we do have grass plus cash, there's some other things to consider, of course, that are headwinds. Right now we're in an environment where interest rates are higher and we are just facing higher input costs. Labor is hard to find, of course, in agriculture areas, and then the aging producer. And then the market volatility and economic uncertainty. That's something that can be managed, but it is a lot of money on the table and a lot of money at risk. And then we think back to the last cycle, 2015 to 16, when we saw all the losses for cattle, when prices moved the other way. And so that's another headwind that's probably keeping some some producers from expanding here in a big way, even though we are seeing these factors. And as we think about the grass, we'll get into weather real quick. So if we look at this drought monitor, most of the country is in decent shape, except for, of course, the Southwest is in pretty severe drought. And if we think going forward, given the weather pattern that we're in, it's probably not going to get a lot better. And then there's still quite a bit of dryness here in the northern plains as well. This is a little bit dated. I think these areas have improved, but the southwest region really hasn't to this point. And so we think about what pattern we're in. We're in a neutral pattern here for the weather cycle, so not a La Nina or El Nino. This time last year, we were in an El Nino, which is typically wetter through most of the U.S. But here in this neutral pattern, if we look at the precipitation in neutral summers, it's actually pretty good, especially for you all's region here. Corn Belt should see decent moisture. We are seeing that so far. But as we move into the fall, we do see a lot more orange here on this chart, which indicates drought here in the east, and then also, of course, the west and southern plains. So this area is already what's seeing a lot of drought, and typically in this weather pattern, we don't see that get a lot better. One thing about neutral, though, is that it can be pretty spotty and pretty mixed by year, so there's a lot of variation within these. But generally, it's a better pattern than what we see for La Nina, but not nearly as much precipitation as the El Nino. As we move forward, odds do increase for the La Nina, and we're continuing to see that. So El Nino is probably not going to be seen at least for the next several months or through the end of the year if we just look at what the probabilities would favor. So if we think about input prices, grains in particular, corn prices have been pretty range bound here. The latest stocks to use expectation is going to be more corn in the new crop year. So if we look at last year, going into the crop year, we had a pretty high stocks to use expectation, so 14% compared to when it was below 10% here in this time. And then corn was up at $7 a bushel at times or above. Now we are in a better, more comfortable stocks to use. It tends to be if we're above 10%, we are more comfortable. And then that keeps prices more range bound, kind of a cap on those. But as we did move through the last crop year, we did continue to see the stocks to use go down as we saw exports come in a little bit stronger, and then production not quite to the levels that were expected. This year, like I said, we do expect more than what we're finishing this year at, because we are going to see record large, or we're going to see more acres of corn, not record large, but more acres of corn planted this year. And we're expecting a pretty good yield with that. So if we do see more drought, there is a risk to this. But to this point, we do expect that prices are going to be more range bound between this 375 to 515, and then averaging right around this 450. So pretty range bound for prices, but maybe averaging a little bit above year ago levels. We look at hay production. We saw a strong production in 2024. It wasn't necessarily that many acres, but it was really good yields last year. But still, if you look historically, this isn't a huge number. It did help rebuild some stocks, but if we look at 2025, we're seeing not quite as good of acres there. And so that's going to be relatively tight hay supplies, and that's definitely going to be regional dependent. But is something to watch if you're monitoring your input cost is that hay could be more limited than, or it could continue to be more limited like we've seen the last several years, aside from maybe last year. And if we look at prices, though, they have moved off a lot from 2022, and we do expect production to be above that level. But that is a risk if we see more drought, especially in those big hay regions. We could see some upward price risk throughout the U.S. Now, the West is what really went up last time, and that's where we're seeing the drought, and that's where we saw the drought in 2022 as well. So it's going to be pretty regional dependent there, but if anything, I would say there's more upward risk rather than risk of moving lower on the hay. So like I said, we're at the lows of the cattle herd, or the beef cow inventory is what we would say. So 2025, we think is the low. We just see a small increase if we look at 2026, so just up 50,000. And a lot of that is that we didn't have the replacement heifers here to start 2025. So replacement heifers were down again. We do think that's the low in them, but even if we add more heifers to the herd to start next year, they don't count as a cow until 2027. And so that's where we see more substantial growth to the herd than on into 2028. Now, one thing that I talked about earlier is one thing that's on a lot of producers' minds is the way that prices moved the other way in the previous cycle. But if we look at what inventory did in the previous cycle, we saw about 1 million head year over year increase to the beef cow herd, and then another one the next year. So that was a sharp increase. There was a lot more replacement heifers in that cycle. And so it was a really rapid expansion. And we're obviously not seeing that with our heifer retention, at least to this point. So we don't see a 1 million head increase to the beef cow herd anytime soon. And so we do think supplies are going to stay tighter, and that's going to support our values for longer than what we saw in the previous cycle. So we would say this is more of a saucer shaped cycle rather than that V-shaped bottom and then upward movement for supplies that we saw last cycle. So we do think there's quite a few differences if we compare the two cycles, and that's why we don't expect the same kind of price movement. One way that we're going to grow the herd, since we don't have more heifers, is we're culling less, and we do see that now. When that's below 10%, you do tend to see a little bit of growth, maybe not expansion, but at least stabilization and possibly a little bit of growth. But like I said, not expansion. It's not like we're adding in a big way to this point. And if you look at that range when we were at the very lower end of it, that was the previous cycle, of course. Like I said at the beginning, we are seeing more utilization from the dairy cow side of things. If we think about beef, so the beef on dairy is becoming a larger percentage of our slaughter numbers. It used to be 10 to 12 or 13% of slaughter, of the fed slaughter was coming from the dairy industry. With our beef cow numbers down and our beef inventories down and dairy stable, we're expecting it could get up to 20%, around 20% of the fed slaughter coming from a dairy or beef on dairy background. But if we look at the dairy cow inventories, they're slow to grow. They are seeing overall growth trends since 2000. But if you look at this, this scaling, it's only by 100,000 here for each line. So we've really been in about a 500,000 head range here for the dairy inventory going back the last 25 years. So even if we do see more growth than this, I think the monthly numbers already have us at this 9.4. So even with a little bit more growth, that's still not that large relative to what we see on the beef side, but it is a stable industry, and they are seeing profitability numbers that would suggest growth. But their hold up for growing as well is with lack of replacements. So if we look, they also are probably seeing a low here in 2025. With the beef on dairy, that does limit, or that it takes longer to ratchet up this number because they have to make that decision, of course, on the breeding side. So they're not producing as many heifers. They're using the sex semen and then breeding the rest to the beef on dairy. And so they need to make that decision at the time that they breed them to produce a dairy heifer. And so we are seeing more of that, and we do expect to see fewer of the beef on dairy as they do make more replacements, but that of course takes some time, and we probably won't see more of those till 2026 and then on forward. And so what they're doing to grow it is also shrinking that culling rate. And so if we look for 2024, we were down 1 million head for cow slaughter, and pretty much all of that, some of that was the dairy side, but most of that was fewer beef cows. If we look this year, we're expecting another 400,000 head decline, some on the beef side and then a little bit more on the dairy side, before we do see a little bit more of that, but still staying relatively small for this cow slaughter, as we do look to expand without a lot of heifers available. If we move into our fed slaughter, cattle on feed is running below year-ago levels pretty consistently. You do see an uptick in our expectation for June. We saw a slower marketing pace, of course, in May because we did see smaller slaughter. And then we saw an increase in placements, which is pretty seasonal to see that. And so that's where we do have an increase in supplies for June, but still small relative to year-ago levels, and then getting smaller on forward would be the expectation there, following that seasonal pattern, but remaining below year-ago levels, just with tighter overall supplies. Another thing that's going to draw this down even more is lack of feeder cattle imports from Mexico. So if you look historically, we've been at 1 to 1.2 million head for the imports from Mexico. We would have estimated that last year we would have been at 1.4, except for that the border closed in November. And so that probably kept 150,000 out, we would say, because of that. And then if we think now we've closed the border again, well, we did open back up for a bit, so we got 225,000 across, and now we're shut back down as of May 15th. If we stay closed for, well, we've already been closed for 1 month. The most cattle that we would get is this 800,000 head probably from Mexico, because they do have to do the process at the border that keeps the rate at 20,000 head per week, and they only have a few ports open. But it's looking like it's going to be more than this 1 month. So if we're closed for 3 months, that takes it down to the 600,000, which is about 600,000 fewer than what we would have forecast. And if we're closed 5 months, that's even smaller. If we're closed for the rest of the year, that's about 1 million fewer feeder cattle that we're going to import. And so that's just further drawing down on that fed supply that we're going to have in the cattle on feed numbers. So definitely pulling out of the supply, but it's kind of, well, it's pretty tough to forecast when they're going to open it, if they're going to open it, and then if they do open it, how many they're going to let across and at what rate. So definitely a concern. And then the screwworm is definitely a risk to the industry. But to this point, the border being closed takes out from the supply and really acts as a bullish factor, just further tightening our supply and availability of cattle. So this is our forecast for a steer and heifer slaughter. It could easily be down more than this. We would actually probably say, to this point, we would say down 750,000 for this year. And then still down that 700,000 next year to this point. If we pull out more from the Mexican supply, that just further draws down those numbers. But the important part here is definitely a declining pattern. And if you look from the peak that we saw in 2022, our expectation for the low is down about 3.5 million heads. So big decline here as we do move into the tighter part of the production cycle. The lows right now are forecast for 2027. They could easily be 2026 if we don't see any Mexican feeders allowed now, and then it does reopen to add to that 2027 supply. So the low in steer and heifer slaughter, it could be either one of these, but definitely moving lower here in the next couple of years. One way that we've been offsetting that is by increasing weights. So we saw a 27-pound increase in cold carcass weights last year, which is the equivalent of 1 million head in additional slaughter. So if we think about the non-fed slaughter, which was down 1,030,000 head, and then if we think of fed slaughter last year, which was up 70,000 head, Overall, weights pretty much offset that for about equal production. And if we look at this year, we're tracking to be up another 20 pounds, which is another 7 or 800,000 head. But with the smaller fed and non-fed slaughter, we're still going to see a drop in production this year. But this has definitely been a huge increase. Part of that is a change in the mix. So we are seeing more steers, a few fewer heifers, and then a lot fewer cows, which are lighter carcass weights. So part of this is the mix of slaughter as well, but generally an increasing pattern over time. And we've been outperforming that increasing pattern here lately and expect to continue to see that. And then another way that we're keeping supplies strong is by importing. So this has really been a story of demand. So imports for 2024 were up 24%, and this year they're on track to be up another 10%. Going into the year, we would have expected a 5% increase just because they were already so large. But with the pace we've seen so far, we're definitely attracting the beef imports by the price levels that we're seeing. So this has been demand driven that we're pulling in those imports, and most of the imports is coming in the form of lean product to balance our supplies. So we are still seeing good production on the fed side, but to supplement the lack of cow slaughter we're seeing, we are importing a lot of beef. Exports are of course moving lower because we're producing less. And then other countries are having more trouble competing with our price levels. And so that's just keeping more product around. But even still, we will export. Some of that's coming in the forms of hides and variety meats, but then also a lot of high value US beef that gets sold to countries for tourism and a high value, and then high value items. So ultimately, we're looking at production down 1.5%. The weights are offsetting quite a bit, but not fully like we did see last year. So production actually finished up just a tad last year. But even with production down, with the strength we're seeing in imports and then the slowdown of exports, we do think that we're going to have stronger per capita supplies this year. And then we do think we'll move lower next year if we're expecting that imports won't increase again from these levels, and then exports will move lower again. So, but just a bit. So we will see lower per capita supplies probably in 2026. But to this point, with the demand that we've seen, we've been able to keep per capita supplies about steady here lately, and it was actually higher in 2024. So with more beef in 2024 and then higher prices, we saw demand on par with what we saw in 2020 here. So record large demand, even as we do see these high prices. And as we move into this year, we see supplies up from year ago levels, and the prices that we're putting in so far, that would put in record demand levels for this year. 2026, we do expect to see a slowdown in demand, mostly because we're going to see a smaller per cap supply, and prices are probably not going to increase enough to offset that decline for our measured demand. So this chart is a demand index, so it's taking the per capita supplies of beef and then the price levels and putting it on an index to compare it to previous years. So, and then this blue line here is the retail beef price. So you can see that we've seen pretty rapid and consistent increases here on this retail beef price. We do expect that to slow down. If you look historically, this has happened pretty often where you do see it continue higher for several years, and then it kind of plateaus for a bit before moving higher again, and then finding a level to plateau. So we do think we're around there, but we haven't seen where consumers push back and it stops increasing to this point. So last month we did see retail beef prices at $8.50. So this probably needs to move a little bit higher here, but at some point consumers will push back and the higher prices are really to ration some of the supplies, since we are going to get into tighter supplies at some point. And then we'll see more of a plateau for this all fresh retail beef price. But we've already pushed to obviously record high levels, and even at an inflated, if you inflated previous years, record high price levels here for the retail beef. And what that does is it just puts more money into the industry and into the system. So it all kind of starts here and then passes back to the packer, and then to the cattle feeder, and then back to the stockers and cow-calf producers. So more money in the system is definitely good and healthy for the industry, and we're continuing to see that with good demand growth. And so the way that money gets passed back is through leverage. So if there's tighter supplies than what there is capacity, then that puts more leverage in the hands of the cattle feeder. So that's where we're at today. If you look at this chart, it's a little confusing to look at, but this red line is the weekly average slaughter. So this is the forecast for 2025, of course, expecting it smaller than 2024, then on smaller through the end of the cycle to the lows. Right now, capacity is larger than what our slaughter is, and so we're seeing a lot of packers running 32-hour shift weeks. But during COVID, back before here, where you see the red above the capacity, that's where they were killing on Saturdays, and that's also where the cattle feeder didn't have leverage, because there was a lot more cattle than there was hooks. Now at this point, we've got more hooks than cattle, and so that's where we do see the leverage in the money going back to the cattle producers. As we move forward, definitely a risk here is a packer shutting down, of course, or maybe multiple packers shutting down, like we saw in the previous cycle. So when we do see this red move below the blue, in 2013, we saw plants close, 2014, 2015. And so what that did is that did move it back to a situation where there were more cattle than hooks by 2016. And so that's definitely a risk, is to see capacity shut down. But to this point, that's going to be hard to predict, and we still expect to see capacity remain above this fed cattle or this fed slaughter that we'll have available. So going back to the wholesale level, so from retail to wholesale, there's pretty good leverage as well, because the retailers are needing to secure product. There's limited beef out there. And so we're seeing record high cutout prices for the beef. So this composite cutout is a way to standardize the beef price for a fed steer or a fed cow or fed cattle. It's a way to standardize that price. And right now we're looking at record high levels. So we're up at 365. We do think we're near a high. If you look at the seasonality of this trend, so this gray line, I would say the peak comes in the summer before it does see a slower demand cycle later into summer. And so we do expect to see a correction here, but we did outperform where we thought we'd get to here this summer, just out of good demand and then tighter supplies. So as we move forward, expect to see prices move lower, but we do think there's support here in this 320 range. We've seen prices get down to this 310 range already this year, but we think there's going to be support above that out of tighter slaughter and production levels. But the seasonal would suggest that right now we're at the high, even in the fall, when we do see more demand and stronger prices, we don't expect that to take out the levels we're seeing right now. So then the fed steer tends to follow that. If you look at this historical seasonal, it would suggest highs in April, but as we add more weight and we add more days on feed, cattle aren't available at quite the same time. So that high has been coming a little bit later the last couple years, and it's really been lining up with that beef high, and we expect that to be this year as well. So we think we're putting in the high probably this week near this 235 to 240 range. Last week we traded cattle for a national average at 236. So we think we're going to average higher this week, and then we do expect to see a correction. Still see support at least at this 210 range, but don't be surprised when we do see Fed prices move lower, because we will get into more supplies as more cattle get available and ready to market. So as we do move later into the summer, beef demand slows down and cattle supplies increase. We will see a correction there, but we still see limited downside just out of the tight supply, relatively tight supply, and good demand that we continue to see. Feeder cattle, following the fed cattle, are of course at record levels here, and going to remain elevated because of the tight supplies, and the Mexico situation further tightens the supplies there. And if we look at what the futures have done, and they're at pretty high levels on forward. So while the seasonal would suggest more upside later into the summer, and we might see that, I do think there's some caution there, because if we think about all the news that we've had, everything's been pretty bullish as we do put in record high fed cattle prices. The Mexican borders closed, so no supplies there. Corn prices have been range bound, but are at the lower end right now, compared to what we'd expect the next month or two. So between all those factors, that's really supportive of strong feeder cattle prices. And we do think that now would be a time to manage some of your risk and add some protection. Whatever strategy you want to use, that might be options to leave yourself pretty open, or LRP, which I know Farm Credit offers, is a great way to do that at a reduced price. Or the straight futures market is another option, but there's of course more risk there. But generally, we do think that this seasonal pattern isn't going to quite be as strong as this would show. And what we saw last year was that it did kind of put in the highs in the summer, and did end up taking that out late in the year, but not by a large degree. And like I said, all the news has been pretty bullish here lately for feeder cattle. Looking at the 550s of the calf prices, these have also outperformed expectation. The seasonal pattern would suggest that these would move lower, but again, all the news has been bullish with lack of imports from Mexico. We've seen quite a bit of moisture through a lot of the country here lately, and so that's been supportive of feeders or for these calves as well. And so just a lot of bullish news here that I do think that there's going to be there's limited upside here. And if you look at the seasonal pattern, they do tend to move lower from there. But still limited downside, of course, because of the tight supplies. We're continuing to see smaller calf crops, of course, with the smaller cow herd. So generally supported, but I don't see a lot more upside here for these calves as well, just if we think of where we're at in the market for this year. If we look at the annual average, there's some controversy throughout our office on if the highs are this year or next year, but generally what we do expect for cattle prices is they're going to remain elevated for the next couple of years, and that's going to be driven by the tight supply and then good demand that we're seeing. So it could be this year that they average a bit higher, or it could be 2026 when we are in the tightest supplies. But either way, we're going to be well supported by that tight supplies, and of course averaging higher than what we did last year. And that's coming throughout all levels of the industry. So from the calves to the stockers to the fed cattle, and then of course the cutout as well. Looking at cow values, we're seeing these at records as well, with the tight available cows on the market. We do expect these prices will remain elevated. These prices tend to follow the 90% lean beef prices, and so they're kind of capped by all the imports that we're seeing. So if we weren't seeing all those beef imports, we could see this level higher, but we also wouldn't see as much ground beef available if that was the case. And so these are probably near their highs at this point because we are near the high for the 90% cutout in the ground beef demand moving into the 4th of July. But again, expect a muted seasonal pattern where prices will move lower, but not to the degree, of course, of this seasonal. And the last couple of years, they did soften, but not nearly to the same level. But this is something with management. If you sell your cows whenever you do the fall preg checks, that tends to be when there's the most available and you do see the lowest prices. So if you have the room and feed and availability where it makes sense to keep them, prices do generally trend higher to start the year. So keeping those through the winter, if it makes sense on your operation, is a good way to make some money there on your cull cows if you have to cull some. But generally, we should be around the highs of the cow prices, and that's just because there's not a lot on the market right now. Looking at looking at some value differences that we see for cattle sold on the video auctions. This is using the superior data, so the superior video auctions. If we look at some attributes there that tend to add value, what we've noticed the most is that you tend to see most discounts for horns. Weaning your cattle tends to be a way to see a premium. And then English or Angus dominated genetics tend to perform better in these video auctions. And then doing some kind of VAC protocol that follows one of the buttons that the superior looks for tends to be good. At least 45 days weaned tends to be best there if you look at how cattle perform on the video auction. So those are just some management things that we've noticed that tend to add value to the cattle. We do a cow-calf survey every year. I'll send those results whenever I send this slideshow over to Claire. But one thing that we notice is that high return producers, of course, they keep their costs lower than the other categories, so the low return or average return. And then at the same time, they do see more higher calf values. And so some of that's going to be where they're located. Some areas, of course, are going to see cheaper hay and cheaper pasture. But as far as marketing, the high return producers, they don't compromise on the weaning program, so they do tend to do the 45 days weaning. And then health, nutrition, and genetics, they tend to see better weaning rates, a tighter calving window, so they're able to manage that better, and then also sell their cattle in larger groups. And then genetics, they tend to spend a little bit more on their bulls as well to get those genetics. So it's really a combo that separates these categories, keeping their costs low, so using good management, focusing on their herd quality, and then marketing, so applying for those or qualifying for those programs so that their cattle can be a part of a value-added system to get the maximum return for their cattle. Bred cow values continue to move higher. One cool thing here is that they do tend to follow this fed cattle values pretty closely. So if we look at the monthly, there's actually a 96% correlation between the two, which makes sense that as there is more money in the system, we do see those bred cow values go up. But we do expect that they're probably near a high. They could move a bit higher in the next year, but just by generally tight supplies, we are seeing those bred cow values strengthen pretty significantly this year. Okay, yeah, this is the one that's got the 96% correlation, and you can see that here. Last cycle, we did see this bred cow value move above the fed steer, and that's what we're seeing here as well. But yeah, just generally going to be supported here in the near term. And industry profitability, it continues to move back down to the cow-calf producers. So if we look, that's continued to increase the last 4 years, and as we do continue to see that smaller calf crop, expect the green bar to stay a larger part here. Another big thing is that we're averaging $450 a head if you look at the last 10 years. So we've put a lot more money back throughout the industry by increasing our demand there. So just a lot more money is in the system and available, and we're gaining the leverage here as cattle producers, which makes for a pretty healthy industry. Because back whenever we were plus or minus a break even, there's really no incentive to grow and make that work. But where we are today, we do see the industry as healthy and gaining a larger percentage of that income back to the cattle producer. So here's the key points here is that we do see this cycle pretty different from the last cycle, slower rebuild, and then we do have a lot of pork and poultry, which is better for consumers. It does seem like those would be competing proteins, but to this point, beef demand has way outpaced those other two. And so with the demand in our favor, we do continue to see more of the consumers' money coming to us as they can. And then we've got adequate packing capacity. We are expecting some expansion, but of course slower. So we're going to see tighter supplies for years to come. Imports can only offset that to some degree. Recession is of course a concern. Demand, it can't keep going up forever, but we do expect that to the correction to be limited just from what we've seen from the consumer to this point. Yeah, so managing risk in this highly volatile market is going to definitely be key as we move forward. Even as we expect prices to stay generally higher, there's still a lot of volatility, of course, and higher input costs. So it's very important to manage the risk and be as cost efficient as you can. But that's what I've got. Please feel free to email me with any questions. And Claire, I think we've got a couple minutes for questions anyways.
Yes, absolutely. We have a couple. So again, if you would like to engage with us, you can do that through the chat feature. Mary, I do have one that came in while you were talking, so we can address that one while maybe some others are getting theirs put in. So knowing that calf market is high, will the herd ever get rebuilt?
Yeah, I do think we're starting to see that already. We're seeing a few fewer heifers placed. Part of what drives that is the cost of breeding cows moving above that fed sphere. So it finally makes sense to develop some heifers at this point. And we are starting to see some of that.
Awesome. Okay. And then I had one more. Curious about the UK export and how that potential exports there may play a role.
UK hasn't been as much on our radar, honestly. It's been mostly Australia and Brazil. But if we think about the UK in general, they don't have a very friendly environment for agriculture. Normally, they're a large pork exporter, but we've taken them out as the top global pork exporter because their policies aren't very friendly towards agriculture. So I don't think that they're as large of a risk as Brazil or Australia in the industry, and I don't think that they're going to be sending as much to us.
Okay, well, it looks like that is what we've got and we've got time for today. Thank you again, Mary, for joining us. For those on the call, we will have a recap email that'll be sent out with her presentation, the recording, as well as those survey results that Mary had mentioned. So thank you for your time, Mary. We appreciate you. That wraps us up.
Yeah, thanks, Claire. Thanks, everyone.